So the time now it's 7:58, right? So a couple of more minutes first, right? And we will begin. So I just for those of you who are here, right, to share with you how it's going to be run. It's going to be a 90-minute session. I'll try to keep it within 90 minutes, and I'll have a 5-minute break in between, right? So don't worry that you have to sit through for 90 minutes, right? And bust your butt and and to suffer for so long, because halfway about the 35 or 40-minute mark, we'll have a 5-minute break. We continue on with the content that I want to present. Towards the end, we have some Q&A session, right, to answer any questions that you might have about trading, any Philippine stocks that you want me to analyze. We can look at it as well, right? And hopefully by 9:30 p.m. we can conclude this session, right? And you walk away being a more confident trader, right? That's the agenda for today's webinar, right? And don't worry, I've got nothing to sell you. There's no sign up for my course, blah blah blah, right? Everything here is presented free, right? And as much as possible to equip you with the right skill set to become a successful trader. Yeah, and one thing to mention, right, before we start is that I expect the webinar room to be full, right? I can only hold 1,000 packs. This is the software that I'm using. They only let me hold a maximum of 1,000 traders. So right now we have about 500 traders live at this moment, and more are coming in along the way. So if any chance, right, that you happen to get locked out, right, and you can't come back in, chances are it means that the room is full, right? So if you have a slot right now, treasure it, right? Because as traders are coming in, right, we are oversubscribed. We have, I think, about 3,000 traders registered for this event. There will be some who will not be able to come in. So if you're in right now, treasure your spot, right? And try not to get locked out, right? Because if someone else comes in, take your spot, you realize that you're not able to come into the webinar room. Okay? So anyway, the time now it's 8 p.m., right? I am going to turn off the webcam. You don't need my face to distract you. Right, turn off the webcam. Okay, so we are going to start today's presentation right now. Okay, so welcome, right, my friends, right, from Investorgrams to this webinar, right? This is a collaboration between Investorgrams and Trading with Rayner, and the title of today's webinar is called Profitable Trading Secrets, right? Let's begin. So a little bit about myself, right, in case some of you who do not know who I am. I'm not going to talk about my history, about my trading, how I got involved and blah, 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 but basically, right, I was previously an ex-prop trader. So what a prop trader does is basically I trade the firm's capital to generate a positive return, right? So I was a prop trader for about 2 years. Then I move on to trade for myself. Right now I'm an independent trader as well as a trading educator, right, where I pretty much educate traders, especially retail traders, about trading. So that's where my website, Trading with Rayner, come about. So if you want to connect with me on my website, Investorgrams or Facebook, these are all the links over here that you can see, right? So feel free to reach out. Okay, so you can see these are all the different links over here. Feel free to reach out if you want to. And, just add me as a friend whatsoever. So that's a little bit about me, right? And today's webinar is called a Profitable Trading Secrets. So just to share with you what you can expect is we'll start off, right, sharing with you the 3 biggest mistakes, right, traders make in their trading. I want to share with you what are these 3 mistakes and how you can avoid it, right? After we talk about the 3 mistakes, I'm going to talk about the structure of the market, the stages of the market, the phase of the market that the market moves. The market doesn't move in one straight line. Rather, there's a pattern to how the market moves. And I want to share with you what are these 4 stages. After which, right, I'm going to share with you a chart pattern which I find that is very useful for those of you who trade stocks. I think most of you trade stocks, right? I'm going to share with you this simple chart pattern for you to look for, to trade it. And towards the end, we'll talk about trading plan, how you can develop a trading plan, right? Talking about entries, exits, risk management, and much more. And then we'll conclude today's session, right? So that's the framework of what you can expect for today's session. So with that said, right, let's begin. Right, the 3 deadly mistakes that traders make and how you can avoid it, right? So first and foremost, what are these 3 mistakes, right? So the first one is, let me share with you, right, is this: no risk management, right? So what is risk management? So I want to walk you through what is risk management. So risk management, in essence, right, is basically, right, what you call a managing your risk, right? Because if you think about this, you can have the best trading strategy out there. I don't know what strategy it is, but it could be the best trading strategy, okay? But if you have no risk management, all right, you still end up being a losing trader. And I want to prove this to you very simply, right? So let's say, for example, if you have two traders, one of them is called John, right, and someone is called Sally. Okay, let's say, they both trade the same trading system, right? It makes an average of a 1 to 3 risk to reward on each trade, all right? And it has about a 50% win rate. Okay, so you can see that this clearly is a profitable trading system, right? You make $3 for every dollar you make, every dollar you risk, and you win 50% of the time. So let's say you have a scenario where your trades look something like this, right? You have a lose, 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 win, 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 right? It's possible, right? With a 50% win rate, you could end up with wins and loss, a series of wins and loss that look something like this. And let's say, John being the more aggressive trader, he risks 30% of his account on each trade. And Sally, right, the more conservative trader, risking, let's say, 1%. Right? And let's assume that they all both start with a $10,000 trading account, right? Let's put here $10,000 trading account. Okay? So if you risk 30% of your trading account, let's say you're John, you risk 30%. So what's going to happen is that you get here, the first trade you lose minus 30. Second trade minus 30%, which is about $3,000 per trade, right? Minus 30%, again, minus 30%, minus 30%, right? I'll just illustrate here. By the fourth trade, you can see that John has basically bust his entire trading account. This means his entire trading account, the $10,000, is no more. Okay, even though John is trading a profitable trading system, right? A 1 to 3 risk to reward with an average of 50% win rate. But what about Sally? Let's look at Sally right now. Sally trades the same system and risk 1% on each trade. So again, first trade is a loss for Sally, minus 1%, minus 1%, minus 1%, minus 1%. And then here it's a winning trade, so it's plus 3%, right? Because you make 3 times your original risk, right? 3%, 3%, another 3% for Sally, and another 3% for Sally. And you can see that if you net off the entire return, Sally, at the end of these 8 trades, has made a positive return of 8%, trading this exact system that John is trading. So can you see the impact of risk management on your trading, right? You can have a profitable trading strategy, but if you do not have proper risk management, if you do not know how to manage your risk, if you do not know how to contain the losses, no trading strategy will make you a winner, right? So risk management is so important, right? Bear this in mind, my friends, right? You must have proper risk management, okay? And in the later part of the webinar, I'll share with you, right, on how to actually, calculate your risk and to know how many shares you should be buying for your given account size and for the given size of your stop loss, right? I'll just share with you a very simple tool that you can use to manage your risk. But right now, I want to point out to you that you must have proper risk management, right? This is so, so, so important. And this is the first mistake that traders make, right? They don't have risk management, right? So now you know that risk management is important, right? And you want to avoid making this mistake. Okay, so let's move on, right? Is this is good, right, so far? Okay, so let's move on. So just a quick one, right? So some of you may feel that, hey, that there's no sound coming up, you can't see anything. My suggestion is that if there's anything wrong on your part, chances are is either the internet connection or the something that is wrong on your side. So what you can do is just exit the room quickly and join back in, and you should be able to experience the webinar smoothly. So if there's no sound, picture not moving, right, just quickly exit and come in, right, and things should be back to normal. Okay, so that's the first thing, right? We talk about no risk management. The second thing is this. Okay, just a little bit more about risk management, right? I want to share with you these slides for a quick one, right? So often, right, traders think that, if they lost 20% of their capital, all they need is 20% to get back to break even. But this simple table over here shows you that it's not true. You lose 10% of your money, you need 11% to get back to break even. So you can see, right, if you lose 50% of your money, you need 100% to get back to break even. And if you hit 70, 80, 90%, I would say it's near impossible, right, to even get back to break even, because if you lose 90% of your capital, you need 900% return just to get back to break even. So if you do not want to end up in this scenario where, the odds is steep, right, climbing an uphill battle, have proper risk management, right? Do not, risk a huge chunk of capital on one trade. If you can do that, right, then you can avoid this what they call a risk of ruin, where the deeper the drawdown you get, right, the harder it is to climb out of the hole. Okay, so this is a important table that I want to share with you to practice proper risk management. So the second mistake that I want to share with you is that traders make is what I call chasing the markets, right? They look at a chart, right, and they say the chart is, it's so bullish, right? The market is making new highs. So I think of some of it that you guys have shared is, for example, I think it's Vita, right? I don't really trade the Philippine stock markets, but I think the symbols that keep popping out is all those very common symbols, the MRC or MRX. I don't really know what it is, all right? But basically, a catalyst breaks out, huge bullish candle, market is high, you go long, right? This is what I call chasing the market. So it looks something like this, what I'm referring to, right? The market, let's say, in a consolidation, maybe some new catalyst, a takeover, whatsoever, bam, it breaks out, then bullish, right? And then you, as a trader, you look at the chart at this point and you tell yourself, buy, right? Because, it's so bullish, right? The market is definitely going up, right? The news is bullish, you go buy. And then what happens? Market trickles a little, consolidate, and your hopes are still there because the market has not really reversed. And then the next thing you know, the market, bam, collapse all the way back down towards its breakout area. And you, the trader or investor that buy at this high price, are now stuck, right? Because why? Because you're chasing the market. Okay, so the second thing, right, that traders make is that they chase the market, right? How many of you actually do this, right? I think there's don't have to be shy, right? Because nobody knows who you are here, right? So just, say, right? How many of you are, guilty of this, chasing the market, right? Market is high, you go buy, and then the next thing you know, bam, the thing collapse. All right. So yeah, right. Nothing to be shy, to be afraid of, because I myself, I'm guilty of this. This is why I know it happens, right? And in the later part of the webinar, I'm going to share with you a specific chart pattern for you to trade, so you don't have to chase the markets, right? So don't chase the markets, right? So simply being is that, usually when the news is out, the market looks very bullish. It's usually the worst time to enter. Okay, and when you're chasing the market, it's very difficult for you to place a proper stop loss because the market has already moved so much, right? And there's no proper technical level that you can reference to set a stop loss. So the second mistake that many traders make is that they chase the market. So please bear this in mind and avoid this whenever possible, especially when you see the market is bullish, right? And you know that you want to enter, right? Think again, right? Because if you are chasing the market, know that it's usually the worst time to enter. Okay, so moving on, right? Let's move on, right? This is the second mistake that traders make. They chase the market. The third one is no trading plan. Okay, so this is basically this, right? Is that when you chase the market earlier, you don't have a trading plan because you know where to buy, right? The market is bullish, it's high, so you go and buy. But when you're chasing the market, right, you don't have a plan for exit. How do you know when you're going to exit, right? At which price, right? How much must the market drop before you exit your trade, right? Or if the market, let's say somehow it moves further in your favor, right? At which price would you exit, right? If you don't have any answers to this question, then it means you have no trading plan. And this means you shouldn't be trading, right? You need to have a trading plan. Like, for example, if you look at a business, right, a mom and pop shop, right, selling, opening up a restaurant, right, you need to have a plan to set up the restaurant, to buy the equipment, the pots and pans, to buy the raw ingredients, to hire the waiter, waitress, hire the manager of the restaurant. This is your business plan, right? They will pay for the utility bills and everything, right? This is the restaurant plan to set up a restaurant. And when you are in trading, you also need a plan for it, right? You need to know where to enter your trades, where to exit, how to manage your trade if it goes against you, how to manage your trades if it goes in your favor. How much do you risk per trade? So this is what I mean by a trading plan. It's like a business. You run a restaurant, there's a plan for it. You fly an aeroplane, you have a checklist, a plan for it. You're a trader in the markets, you must have a plan for it. And often traders come into the markets without a plan, right? So this is, again, is a mistake because without a plan, you'll be basing your actions on subjectivity, based on how you feel. Like, for example, right, chasing the market, it's basically trading based on how you feel. And I think you can agree how it usually works out if you're entering and exiting your trades based on how you feel, right? So you need to have a plan. And again, don't worry, right? You do not know how to create one. In the later part of the webinar, we'll talk about how you can develop your own trading plan, right? So I've got your back on this, right? So in essence, right, the 3 mistakes that I've just shared with you is number 1, right, no risk management. Number 2, traders like to chase the market. And number 3, they do not have a trading plan. Okay, so these are the 3 mistakes, right? If you know what they are, right, you want to do your best, your utmost to actually avoid making these mistakes. Because once you can avoid making these mistakes, right, you have a pretty good chance, right, of actually, making it in this business. Okay. So with that said, right, now that you've understand, what are the mistakes that I've just shared with you, the next thing I want to talk about is the 4 stages of the market, right? So we're going to get a little bit into the technical part of this session, right? I'm going to talk about technical analysis, and the first thing which I find that is very important for any trader, whether you're a day trader, swing trader, position trader, is to understand the 4 stages of the market. The market moves in cycle, right? Like winter, autumn, spring, summer. It moves in cycle, and I want to share with you what are these 4 stages of the markets are. Okay, so let's begin. The first stage of the market is what I call the accumulation stage. Okay, so I'll explain to you what that is later, but just understand the terminology first. The accumulation stage is what I call the first stage of the market. After the accumulation stage is what we call the advancing stage. All right, and after the advancing stage is where we move on into the distribution stage. And after the distribution stage is where we go into the final leg of the move, is what we call the declining stage. So to show you how it all works is that from accumulation you go to advancing you move on to distribution, right? And distribution you move on to declining, and declining, right, you then go back to the accumulation stage, right? So this is the cycle that the market moves. So I'm going to explain to you step by step and in depth, right, how it looks like. Okay, so let's see how it looks like, right? So first and foremost, the accumulation stage, right? So I'm going to illustrate to you, using my own drawing. It may look ridiculous, but bear with me, right? So the accumulation stage basically looks something like this, is that, if you recall, right, the declining stage, after the declining, you move on to the accumulation stage. So the declining stage looks something like this, right, in a downtrend. So the accumulation stage is basically a range, right, a prolonged range within a downtrend. It looks something like this. So you can see it's in a range, right? But the key thing to take note is that it's a range that occurred in a downtrend. Okay, so this is what we call the accumulation stage, because this is where the institution, the big boys, they want to accumulate their positions in this market condition. This is where the news are bad, right? Bad news, negative earnings, blah, 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 right? Price has dropped and then it moves into a range. No one dares to buy because the fundamentals are so bad. And this is where, institutions, the smart money wants to accumulate positions, because this is where price is cheap, right? Price is low. Accumulation stage. Okay, so before we talk about the next stage, right, just to share with you an example of what the accumulation stage looks like, right? Basically, it's a range in a downtrend, as I've just mentioned, a range in a downtrend. The 200 period moving average starts to flatten, right? MA stands for moving average, right? And it looks something like this, right? I'm using the examples from the Forex and futures market because those are the primary markets I trade, but this concept can be applied to the stock markets as well. You just look through your charts and you see what I mean. So you can see that this again, right? Downtrend, right? Previous downtrend. You can identify this range over here. You look at the 200 MA, which is this one over here, this 200 MA. You notice that it starts to flatten, right? Previously it was down and then it starts to flatten, right? So this is a sign of a potential accumulation stage, right? So one thing that I want to mention is that the accumulation stage, right, you never know whether it's confirmed until the market breaks out. So if the market is still in the range, right, it's not confirmed, it's only potential, right? And in trading, we are dealing with probabilities, not certainty. So it won't be wise to say, oh, this market is definitely in an accumulation stage, or it has to break out higher. No, right? Because the market can just as well break down lower, right? So this is what I mean by, embracing the probabilities, the uncertainty that trading brings, right? So when you see a potential accumulation stage, don't tell yourself that it definitely must go up, because it could just as well go down. Okay, so bear this in mind. Okay, so once the market breaks out of the accumulation stage is where we move on into the advancing stage. So I'm going to draw to you what it looks like, right? So you know that the market in an accumulation stage looks like this. It breaks out, all right, and it forms higher highs and higher lows, is what we call the advancing stage. So this is where the market will be, the price will, is in an uptrend. I think it's a term that most of you will be familiar with. The market is in an uptrend. The price is above the 200 MA, right? More often than not, it's above the 200 period moving average. Okay, so you can see that it's an uptrend. The bullish candles tend to be larger than the bearish candles, because if you notice that in an uptrend, the green candles tend to be bigger than the red candles. And the price is above the 200 period moving average, right? So another example on this is this one over here. This is a chart of euro dollar. But again, you can see this on the stock markets, whether Philippine stocks, US stocks, whatsoever, the concept holds. Okay, so previously this is the accumulation stage. Price breaks out, form a series of higher highs and higher lows. All right, this is the 200 MA. Right, the price is above it. So this, you'll conclude that this is an advancing stage. So when you see an advancing stage, right, you want to be long, right? You don't want to try and short this market. I think in Philippines you guys don't have the ability to short. So I'll just ignore that, right? Since that's something that is not allowed in the Philippines, right? So when you see an advancing stage, right, you want to be bullish, right? Because this is where the market is making higher highs and higher lows. Okay, so this is number 2, the advancing stage. And moving on, right, is what I call the distribution stage, because I'm sure you know, right, that no stock goes up forever, right? It will come to a point where where everybody has already bought their share. When everybody bought their share, right, what's going to happen? Well, there's no one left to buy. And what happens when there's no one left to buy? Well, it starts to drop, right? As we know, people take profits, right? They want to protect their gains. The market starts to reverse. So an advancing stage looks something like this. A distribution stage is just basically the opposite of an advancing stage. I mean, the accumulation stage. It's basically a range in an uptrend. Okay? So when the market breaks below this area of support, you would say, right, this is a distribution stage. And again, right, one thing to point out is that just because you see a range in an uptrend, it doesn't mean that the market will definitely reverse lower, because there's a good chance that it could just continue and break up towards the highs. And this is why, I like to use the term potential, right? Always, think of a probabilities, right? The potential that it could occur, and not with certainty, right? So this is generally how the distribution stage look like, right? So if you kind of, if you're a swing trader and you notice that the market is in a distribution stage, and let's say it breaks and closes below this area of support, right? It kind of makes sense to tell yourself that, hey, I better bail out of this stock. I better sell my stocks, because if this really works out, right, the market could reverse lower. So you can use the distribution stage to potentially alert you to where you might want to take your profits. Okay, so this is the distribution stage. And basically a range in an uptrend, and your 200 MA usually starts to flatten. So you can see that it looks something like this one over here, right? Previously, you have this advancing stage, a long period of distribution over here, right? 200 MA, look at it, right? Previously, the 200 MA is pretty pointing higher. Then it starts to flatten over here, okay? So this over here, this whole portion over here is a distribution stage, basically a range in an uptrend. And what happens after the distribution stage is where we move on into the declining stage. So just to share with you, right, distribution stage is something like this. Market breaks down this area of support, right? This is a sign of trouble. If you are holding on to your stocks, right, you may want to consider exiting them, selling them. And after this breakdown, the market moves into a declining stage where you would see a otherwise known as a downtrend. Okay, so since you all can't short the markets, I won't talk about shorting, right? But this is basically what a declining stage looks like. So it's basically a downtrend, right? Price below the 200 period moving average. So you can see that it looks something like this. Price below the 200 period moving average. So if you look at a stock chart, I don't care what stock it is, whether it's a Philippine stock, a stock you own or whatsoever. If you're a trader and the chart looks something like what you're looking at right now, a declining stage, I would say you have no reason to be long or to buy, because I mean, unless you're an investor, you're trading, you're buying based on fundamentals, right? Then you can ignore what I'm going to share with you right now. But if you're a trader and you buy and your chart looks like what you're seeing right now, I would say you have no business to remain long, right? Because this is clearly a declining stage, right? There's no point no holding on to your losers, praying that it would reverse, right? Cut your losses and find a better chart pattern to trade. Okay, so this is a declining stage, right? Very important, right? Because a lot of times, if you look at your major losses, right, it's because the market is in a declining stage and you refuse to cut the loss, and this is why your losses has snowballed even bigger. Okay, so this is a declining stage. All right, so just a quick recap to what we've talked so far. Okay, so I've shared with you, right, so far the 4 stages of the market. Right, we talk about the accumulation stage, we talk about the advancing stage, which is otherwise known as an uptrend. Right, we talk about the distribution stage. It's pretty much a range market in an uptrend. Okay, and the 4th one is basically the declining stage, where the market is in a downtrend and you don't want to be holding or buying stocks in a declining stage. Okay, so these are the 4 stages of the market. And the time now it's 8:25, right? In the next section, I think you may have taken a peep already, right? I'm going to share with you a very simple but powerful chart pattern, right? That you can consider trading, right? That actually offers very favorable risk to reward, right? But before I share with you what that chart pattern is, right? Go for a quick 5 minutes break, okay? And I'll see you back here at 8:30, and we'll carry on the second half of the session. Okay, so the time now is about 8:25. Just go for a short 5 minutes break and come back. We'll talk about that particular chart pattern, right? How you can spot it. Then we'll talk about having a trading plan, and we'll end off with some Q&A session for today's webinar. Okay, so enjoy the break, and I'll catch you in 5 minutes time. So along the way, I'm seeing some questions that is coming in, right? So I would appreciate if you can hold your questions towards the end of the webinar, because if not, it's going to be very distracting, right, for me to answer a little bit of questions every now and then before carrying on with the materials, answer a few more questions. It's just not going to be a pleasant experience. If any questions, right, we have some time for the Q&A, right, towards the end. Hold your horses for then, right, and then I'll answer your questions at that point in time. Okay, so far so good, right? Oh, fantastic. Ivor, right, you're welcome. Robert, right? So enjoy the break, right? And we'll be back here in a few minutes time. Okay, so some of you are okay, so I think just generally the comments are thank you, fantastic, right? I'm happy to see that you all are finding value in what I've just shared. A question asking about from Mark is, where can I buy the physical? Oh yeah, right. So the physical book that I just released, right? So the physical book is actually only available in the Singapore bookstores. if you want to get a copy, I suggest, waiting for it to be uploaded to Amazon, and then you can just buy it off Amazon at a later date, and I'll update you when it's available, right? But right now, it's just available to people in Singapore. And I do apologize for it, right? So I don't really want to deprive, the international audience, but at this point in time, right, that's the way it is right now. Okay, so the time now, it's 8:30, right? As promised, right? 5 minutes break, right? To be fair, for those of you who are already back, right? Let's begin, right? And talk about the chart pattern that I mentioned to you earlier that I want to share with you. Right? To me, this is a very powerful chart pattern. For any type of trader, whether it's stock trader, futures trader, forex trader, this chart pattern, basically, it's something that is worth learning, right? And for stock traders, you have the benefit of trading many thousands of stocks, right? So if one stock don't have this pattern, you can always, scan the remaining stock for this particular pattern, right? Unlike forex trader, where you only have like 20, 30 currency pairs, there's a limit to how many of such patterns we can find. But for stock traders, you have the ability to really, keep finding this particular chart pattern. And I want to share with you, what this is and explain to you why this is so powerful. Okay, so to briefly explain to you, right? Let me just explain to you briefly what to look for, right? You want to trade this pattern is basically it's in a when the market is in a potential accumulation stage, right? Because as you've seen earlier, when the market is in a potential accumulation stage, right, and if it does breaks out and become the advancing stage, that's where a huge move would result, right? So this is why you want to enter your trades as much as possible during the accumulation stage or in the early stages of the advancing stage. Okay, the next thing you want to look for is a build up to be formed at the highs of resistance, right? I'll explain to you later what this looks like. And then the third thing, right, as your entry trigger is just a simple break and close above resistance, right? Later I'll share with you where you can put your stop loss and stuff like that, but just want to, walk you through, right, the schematics on how this particular pattern look like. So basically what you're trying to look for is, again, a advancing stage, something like this. Okay, I mentioned it's to look for is first thing is for the market to be in a potential accumulation stage. Second thing is for a build up. So what is a build up? A build up is basically a tight consolidation. Basically, you want to see a narrow range of candles forming either just before this resistance here, or it can be after the resistance. Both scenario, there are different variations of it, right? But both can work. Right? So you're going to see a tight build up form over here. Basically, small bodied candles, right? The tighter the better, form just before this area of resistance. And if the market breaks and closes above this area of resistance, you want to buy and go long. Okay? The beauty of this pattern is that you can reference this low over here, the lows of the build up, to set your stop loss, right? Just say somewhere over here. So you can see that instead of chasing the market where the market has already moved so far and you have no relevant place to put your stop loss, this particular pattern, right, offers you a level where you can reference and set your stop loss, right? So this is a pattern that you want to pay attention to, right? A potential accumulation stage and a build up form at the highs of resistance, right? So this is the chart pattern, right? Another variation of this pattern, right, is something like this. So instead of a build up you get, right, what you have is a series of higher lows coming into resistance, something like this. Okay, for those of you who are familiar with classical chart pattern, it looks something like an ascending triangle. You have a series of higher lows coming into this area of resistance, right? And then it finally breaks out. This pattern, right, is equally good to trade as well. So there are variations of one another, right? It's not possible, right, within this 90-minute webinar to share with you all the different variations, but understand the concept, right? What you want to do is to buy when the market is about to break out of the accumulation stage. And I've shared with you, right, two possible variations. This one over here where you have a series of higher lows coming in, or the previous one where you saw, right, there's a build-up form at the area of resistance. Okay? So one thing to point out, right, is you don't want to trade when this happens, right? For example, the market is in a potential accumulation stage. Okay? The market then from here just rally and breaks out over here. You don't want to buy. I won't really recommend buying when the market does this, because you can see, right, from this low to this high, the market has already traveled quite a bit, right? And there's a good chance the market could actually reverse back lower, right? So don't buy after a huge move has occurred. Buy only when the market is boring, when it's not moving, when it's down, when it's low volatility. You want to be interested to buy when the market shows a signs of breakout, right? Because, there's not much interest gathered so far. But from this lows to this highs, right, the market has already expended considerable amount of energy, right? And more often than not, right, the breakout here tends to fail. So look for a build up that I shared with you earlier. Look for an ascending triangle pattern, right? Higher lows into the resistance, right? These are better breakout trades that you want to be looking for. Okay, so a few examples, right? This one over here, you can see the accumulation stage, right? 200 MA starting to flatten over here. You can see the build up that I mentioned over here. The tighter it is, the better. You can buy when the market breaks out above it, right? And ride this move up higher. One thing to point out is I have purposely cherry picked this chart to illustrate my point. When you trade this live, there will be losses, right? I'm not going to say that this is the best chart pattern, the best strategy. There will be losses, right? The secret, if you want to know the secret to making this work, is to cut your losses and ride your winners. Okay? And I'll share with you again later on how to ride your winners. But for now, just look at this pattern. All right, get familiar with it. Look through your past trades, the past charts, before the market, before a stock breaks out. What is the pattern that is being formed, right? And see whether this is the pattern that I've just shared with you. Okay, let's look at another example. All right, this one is the soybean futures market. Again, same concept. Potential accumulation stage, right? 200 MA starting to flatten. You have this build-up form at the highs over here, breaks out, and then a nice run. All right, another example. Again, you can see, right, this over here, this range is pretty large, but again, the concept is the same, right? You have a nice tight build-up form near the highs of resistance, and then it breaks out, right? So this is the pattern that I want to share with you. I find that it's a very powerful chart pattern, especially for stock traders. We have so many hundreds or thousands of stocks to trade, right? This is a pattern that is worth learning. Okay, so with that said, right, I've shared with you what this pattern is, right? The next thing that I want to talk about, right, is that there is no point, right, learning the pattern, knowing when to enter, but you can't catch the move, right? You buy the stock, it moves up $2, you take profits, and the stock makes another $50 higher, right? So I'm going to share with you a very simple technique on how you can ride big trends in the market, right? Don't have to complicate your trading, right? So the secret is this, is that you have to trail your stop loss, right? So this means is that you can't have a profit target. So for example, you buy a stock at, let's say, $10, right? And the stock moved to $15, you exit your position because, you're up 50%. No, you can't do that, because if you do that, what you're essentially doing is telling the market that, hey, don't give me too much profits. It's enough, right? $5 or 50% gain is enough. I don't want anything more. That's what you're telling the market when you're having a predetermined stop loss. I mean, a predetermined target profit. So what you want to do instead is to actually let the market reward you, right? Don't tell the market how much is enough, right? The market will tell you how much is enough, right? You don't tell the market that. And you let the market reward you by using a trailing stop loss. So I'm going to share with you a few techniques that you can use, right? The first one is just moving average. You can use, for example, a 50-period moving average, right? If the price is above it, right, you hold your position. And if the market breaks and closes below the moving average, you exit your trade, right? That's a first technique that you can use, and it's one of the most straightforward one. The other technique that you can use is what I call structure. This one is a little bit more towards the price action side of things, where the market makes a series of higher highs, higher lows. So when it makes a series of lower highs and lower lows, then you exit your position, because this is a sign that the market is about to potentially reverse. So this is the second approach, is a structure. Okay, so if you ask me, right, I would say the easier approach is to just use moving average to trail your stop loss, right? As long as the price is above the moving average, you hold that position, right? And if the market breaks and closes below it, you exit your trade. So some of you may be wondering, hey, Rayner, there's so many moving average of the 10, 20, 50, 100, 200, which moving average should you use, right? So there is no right or wrong answer to it, but generally, I want to share with you some general guidelines, right? If you want to ride a short-term trend, right, you can trail using the 20-period moving average. This is for short-term trend. If you want to ride a medium-term trend, right, then you can trail using the 50-period moving average, okay? And if you want to ride a long-term trend, you can do anywhere from 100 moving average, 100-period moving average and above, right? So I won't say there is a best moving average, because it doesn't exist. It depends on you, the trader, on what type of trend you want to capture, the type of trend that you want to ride, right? So it's all dependent on you. Okay, so 20, 50, 100, right? I leave it to you based on your own trading objectives. Okay, so now that I've shared with you how to write trends, right? Let's see. Maybe I just share with you an example. We'll talk about examples later on, right? So for now, right, I want to talk about how to actually develop a trading plan, right? Because this is something that you have learned earlier, right? That most traders they trade without a plan, right? They enter based on emotions, exit based on emotions, and they get disastrous trading results. So I'm going to share with you, right, a framework that you can use to develop a trading plan. So in future, whenever you put on a trade, right, you can just look at your trading plan and ask yourself, right, whether the trade meets your plan. If it does, right, you can take the trade. If it doesn't, right, then, hey, skip the trade and move on. Okay, so how do you develop a trading plan, right? So first and foremost, right, you need to predefine, right, the conditions of your trading setup. What is the thing that warrants a buy trade? What is the condition that you're looking for? So you need to define this. You need to talk about the entries, right? How will you enter the trade? Are you going to enter on a breakout? Are you going to enter on a pullback, right? What is the specific entry trigger that you're looking for? The third thing you need to think about is your exits, right? How will you exit your losing trade, right? Where will you put your stop loss? Exits, right? Then you need to consider about your trade management, right? If the market moves in your favor, what are you going to do? Are you going to scale in your trades? Are you going to scale out your trades? Are you going to, trail your stop loss to ride the trend, right? Your trade management. Then we need to talk about your risk management, right? Again, if you recall back to the early part of this webinar, right? You don't want to be betting the farm, right? Because without proper risk management, right, you can potentially, remain a losing trader even though you have a profitable trading strategy. Right, so a simple way to develop a trading plan is what I like to call the if-then syntax, right? I'm not sure how many of you here are programmers, right? Any programmers down here in the house today, right? You program with C++, I know Java, whatsoever. Right? We have J, Francis, COBOL, all right? So Visual Basic, all right? So basically, number of you are familiar with programming, right? So I'm going to share with you this simple syntax that you can use, right? I call it the if-then syntax, right? So if something happens, then you do this, right? So if you're a boy, then you wear a pants. If you're a girl, then you wear a skirt. If you're not a boy or a girl, then maybe you wear nothing, right? Don't wear anything, right? Okay, so we're going to use this if-then syntax to develop your trading plan. So, for example, right, learning the simple chart pattern that you have seen earlier, we can start with, if the market is in a potential accumulation stage, right, then wait for a build up to form, right? So if you recall, right, we are looking for a build up at the highs of resistance to form, right, before we take the trade. So if there's a build up, okay, form, right, then you wait for the price to break and close above resistance or above the highs that you have highlighted. If the price breaks above resistance, or a little bit of spelling error, if the price breaks above resistance, okay, if the price breaks above resistance, go along with stop loss 1 ATR below swing low, right? I'll explain that later, what is 1 ATR and how do you set that. And then if the market moves in your favor, right, trail your stop loss with the 50 period moving average. So this is basically your trade management, how you handle the trade if it moves in your favor. Right, so you can see that this framework that I shared with you has basically answered all the questions. All these questions over here. Right, the conditions, the entries, the exits, trade management, and risk management. I think risk management I have not covered yet, but basically you can see that the bulk of it has been answered. Risk management will be, the 1% risk on each trade, right? I'll talk about that later. But for now, let's just look at an example. So again, this one, first criteria is to look for an accumulation stage and a build-up form over here. Then a break and close above the resistance, go long, okay? Stop loss, right, is 1 ATR below this swing low. So you pull out your ATR indicator, stand for the average true range, right? Find out what's the value of the average true range. Find out what's the low over here and minus the average true range, and you get a value, and your stop loss will be somewhere around here. So you can see that as the market moves in your favor, right, you will trail your stop loss and exit only when the market breaks and closes below this 50 period moving average, right? So this is an example. Let me see if I have more example for you. I'll find for you more examples so you kind of understand where I'm coming from. Okay, let's see. So I'm probably going to cover the FX and futures market. So since those are the primary markets I trade, but we can have a look at the Philippine stock markets later on if you want. Okay, so this is another example. Okay, so get out the 50 MA. You can see that over here, this portion is again the accumulation stage that we seen earlier. Okay, it's not really working out for me. Then we have this build up form over here. Market breaks and close above it, go long, right? Stop loss 1 ATR below this low, which is somewhere here, right? And as the market move in your favor, you trail using the 50 period moving average. So you can see that you would exit, right, when the market breaks and close below the 50 period moving average. Just to share with you what is the ATR, right? Let me just get out this indicator. I believe it's available on most charting platform, right? So ATR is this line over here. So you can see over here at this point in time when the market breaks out, right? You look at what is the ATR value. So for this market, it's about 80 pips. Okay. So in Forex term, we call it pips, right? For stock, I think you'll call it ticks. So 80 pips, right? So what you find is that you find out what's the low of this price over here. And you minus 80 pips. And that's it, right? And that will be your stop loss, which will be somewhere around here. So this is the idea of, using this average true range to set your stop loss, right? So the average true range basically takes into account the volatility of the markets, right? Because you don't have too tight of a stop loss, right? Where the market, before it can move in your favor, right? It hits your stops and then continue moving in your favor. So you're going to give your trade some breathing room, right? To run, right? So this is where this stop loss technique, right? Could help you with it. Okay, so moving on. Okay, so now that you have the idea of how the trading setup looks like, right, I want to talk about the risk management, right, because that is also part of your trading plan. So for risk management, it's very straightforward, right? I suggest risking 1% on each trade. So what this means is that if you have, let's say, your account is, let's say, I don't know, 10,000 peso, okay? So each trade you risk, right, should, if you hit your stop loss, right, should cause you not to lose more than $100. Okay, so this is what I mean by the 1% on each trade. And how do you calculate this? All right, how many shares do you know that you need to buy, right? So that your loss will not exceed $100. So let me share this with you. A simple tool that you can use, right? It's called a stock position sizing calculator. Let me find it where I can bring it out. Okay, just Google stock position size calculator. I'm sure you can find something. This one. Okay, let's try this. Okay, so I just Googled something and then this came up. Okay, so this is a stock position size calculator. Very simple, right? So let's say again you have a $10,000 trading account. I mentioned risk 1%. Let's say entry price, right? Let's say the stock that you want to buy, the entry price is at $50, right? And then you decided that your stop loss, right, will be, let's say, $45. Okay, $45. So how many shares can you buy? So that if the market hits your stop loss, right, you end up losing 1% of your trading account, which is $100. Well, if you look at it, right, your entry to stop is 5. So you look at 5, you can buy 20 shares. Okay, you can buy 20 shares. And if the market hits your stop loss, right, you will know that the loss will not be more than $100, excluding slippage. So this is a very simple stock position sizing calculator you can use. You can just Google stock position sizing calculator, right, and you'll find there are different calculators, mostly free, right, to help you with your position sizing on your stocks. Okay, so that's how you can go about calculating your risk management, right? 1% on each trade. It's not difficult. And yeah, all right. So some trading tips, right, before I end off, this webinar session, right? So some tips to share with you is number one. Right, in terms of the chart pattern I share with you, right, the best setups, right, usually occur when your stock index does a correction. So for those of you, I think most of you trade the Philippine stock markets, right? So the PSE, the Philippine Stock Exchange, right, the index, when it does a correction, okay, you want to start looking for these patterns on individual stocks. All right, because when the market is in a correction, right, and so let's say this is the index, right? Index does a correction, right? A correction, right? And your stock, right, happens to look something like this, right? It's in a range, right? This is actually a sign of strength over here, because as the index does a pullback, let's just call this the index, and this is your stock. This is what I call the relative strength concept, because as the index does a correction, most stocks, right, in the within the index will tend to do a pullback as well. Usually, as much as the index or even more. So if your stock can exhibit sign of strength, right, where it's still in a range, right, it's still hovering near the highs of the resistance. Let's say that the index does a pullback, but your stock can still hover near the highs of resistance, right? This is a good setup because it's telling you that this stock is has a high relative strength, right? It's resilient to the down move, the pullback on the pullback on the stock index. So when the stock breaks out, right, this is actually a much more favorable setup to look for, right? When the stock index does a correction and your stock is actually holding up pretty well. Okay, so this is the first thing I want to share with you. All right, the best setups occur when the stock index does a correction. The second thing to share is the tighter the build up, the better. Okay, so this means, right, the build up you have learned, right? The build up is basically when the market is at the highs over here. The tighter the build up, the better, right? You want to see low volatility, right? The range of the candles are very small, right? Not much interest, right? The tighter the build up, the better, because it's like a spring, right? The tighter it is, right, the more you contract it, right, the greater it would expand, right? So you want to look for the tighter the build up, the better. The third thing to consider is the longer the pattern takes to form, the better as well. So if you're trading off the daily time frame, right, if the pattern takes 5 months or more to form, right, it's better because it's telling you that there are not much traders interested in this stock, right, and there will be less sellers to push the price lower if it does break out. So usually if the patterns, the accumulation stage, right, takes 5 months or more to form, right, the better the odds of it working out. And last but not least, right, is again a very important tip, right? Avoid trading in bear market, right? I think it's common sense, right, to know that when the stock market, the index is in the bear market, it's in a downtrend. Most of the stocks are just going to go down with it, right? No point fighting against the trend. No point fighting against the tide, right? In such cases, right, it's better to just stay in cash, right, and just just stay in cash, right? Play defensive, right? So if the Philippine stock index, right, is in the bear market, is below the 200 MA, I suggest, right, not even looking to buy, right, because you're basically going against the trend, against the tide, and your odds are quite low, right, to find a stock that actually can go against the stock market index, right? So these are 4 tips, right, to help you, identify these best chart patterns to trade. Okay, so with that said, right, let's do a quick recap to what we have covered so far in this webinar. Right, firstly, right, I talk about the 3 mistakes that traders make: trading without a plan, chasing the markets, and no proper risk management. And then in this webinar, I've clearly laid out, right, step by step what you can do to avoid these 3 mistakes. Then we spoke about the 4 stages of the market, right? The accumulation stage, the advancing stage, the distribution stage, and the declining stage. I said that if the market is in a declining stage, you shouldn't be holding any long positions because it's in a downtrend. Okay, the best times to enter your trade is when the market is in an accumulation stage, or when it's about to break out of the accumulation stage, or the early part of the advancing stage. These are the best times to buy a stock. Then I share with you the chart pattern that I spoke about. Right, it looks something like this. Right, this is the chart pattern, the range, a build up form, then breaks out. Right, ideally your 200 MA starts to flatten as well. Right, you want to look for this particular chart pattern to trade. And trading plan development, we talk about entries, exits, trade management. Okay, and I say that if you want to trail your profits, you want to ride trends in the market, you can use the moving average, like the 50 period moving average, to ride a medium-term trends in the market. Okay, so with that said, right, I have come to the end of today's webinar presentation. I believe it's almost an hour. We have some time left for Q&A session. So if any questions, right, let me know, right, and I'll do my best to answer them, right. So just let me know and I'll answer them one by one, right. So let's start the first one. So I have a question, right? How to actually take profit. So I think I mentioned how one can go about taking profits is to, you can use the trailing stops, right? If you're on the right trends, right, you can, use the moving average to trail your stop loss, right? So you have a possibility of, capturing trends in the market. So that's one way to actually so-called take profits. So Archie asked me, do you believe on the recommendation of the brokers and analysts, right? So I don't really look at brokers recommendation or analyst recommendation because first and foremost, they are not traders, right? They are, you have to understand what is their agenda, or rather what is their self-interest. Their self-interest is to actually, if you think how they make money is through commission, right? Through buying and selling, is to actually incentivize traders, retail traders whatsoever to buy and sell more. That's how they make their money. So to me, right, their analysts, their calls, their recommendation are pretty much, I would say, it has no relevance to you as a trader, because you as a trader, you would depend on your own analysis, your own thought process, your own take on the market. Anything else outside of your analysis is noise and irrelevant to you. So again, you asked about the four stages of the market. Can they be used across different time frames? Yeah, you can use the four stages of the market across different time frame, right? And you'll see that it appears the same as well. The market is fractal, right? So any pattern that you see on a daily and weekly time frame, chances are if the market is liquid enough, you can also see it on the lower time frame. So question is, how do you manage fear and greed? Firstly, right, have a trading plan, right? Once you have a trading plan, you trade with proper risk management, right? It's much more easier to contain your fear and greed. If you're trading without a plan, you're trading too big, you're trading too large, more likely than not, you would give in to your fear and greed, right? So if you want to tell me how to actually better contain your emotions, it all start with having a trading plan. Okay, another question I have is by Ian, right? What indicators do I usually use? I would say the two primary indicators I use are moving average, right? I covered that earlier. Basically, it's good to define the trend as well as trailing your stop loss. And the other indicator I use is the average true range. I think I covered that as well. It's useful to actually help you set a proper stop loss. So someone asked, how does the average true range indicator work? I've written a blog post on it, right? Just go down to my website, tradingwithrayner.com. Look at my blog. I have a ATR, the complete guide to ATR indicator. Go and read it, and I believe that would answer your question. Someone asked, you know what? I'm just going to, reference my website, because most of the stuff that you're asking, right, can be found over there. So the questions that you have for me, I'll just point out where are the links to find them, right? It's all free on my website, and just help yourself instead of me. I think it does a better job than me trying to explain everything in this short session. Okay, so I think I have an ATR question, right? ATR question there, this one. Click here, the complete guide to, sorry, no, this one, ATR indicator. Those who are asking about ATR indicator, you can click on this and find out more. I have another one asking me about best trading books. You just search here books, right? I think you can get a list of this one over here, the best trading books of all time. Right, this is another one that just can click on this link and see which are the ones that I recommend. Okay, so let me see what's the next question. So someone asked, right, for those of you who have a full-time job, how do you be more profitable? So if you have a full-time job, right, then it makes sense to be trading off the daily time frame. I mean, you can't be a day trader with a full-time job because, your commitment just won't allow it. So, stick to the daily time frames, right trends, and, and slowly grow your trading account. I don't see, any magic pill that you can do to, to become a more profitable trader. So I think that's one of the best way you can go about it. Someone asked, right? Princess asked whether do I use Fibonacci to set my to trail my stop loss. Right? No, I don't use Fibonacci. Someone asked what is the 3 deadly mistakes again. All right. The 3 deadly mistakes. Number one is trading without proper risk management. Number two is chasing the markets blindly, and number three is trading without a trading plan. So Jose asked, right, is it possible that there are stocks that go up even though the stock market is in a bear market? I mean, the index is in a bear market. Yeah, of course, right. There are definitely possibilities, right? Especially those penny stocks, right? Those smaller cap stocks, right? But again, right, the odds of it going against the broader index is usually quite slim, right? So why do you want to take that chance? I mean, it makes more sense to stay in cash, right? And when the index becomes bullish again, you can what do you call join back in. So Clarence, you asked any tips on creating a watch list. So the watch list, again, before you can create any watch list or before you can scan for any stocks, you have to understand what is the thing you're looking for. Like for example, I shared with you just now the simple chart pattern that you can use to trade. Yeah, you can create a watch list that have a market that is in a potential accumulation stage. That could make it easier for you to create a watch list on that particular trading setup. Okay, so I'm seeing a lot of questions coming in, right? So let me answer them one by one. So someone asked, how do you use the ATR indicator to set your stop loss, right? Again, go down to my website, right? I believe there is a video on it on how you can go about setting your stop loss. Just Google ATR stop loss, right? And I mean on my website, and you'll be able to find it. So I'm going to look through a stock, right, called Now. Right? I think somehow it's gathered a lot of interest from a number of you. So let's just analyze this and see, I mean, share with you my take on this on this stock. So first and foremost, right, I think it's important to look at the big picture. So you can either zoom out or go to a weekly time frame, whatever, it doesn't really matter, right? So let's see the big picture. Okay, so you can see that this stock, right? Let's look at the daily time frame, right? This is stock that you all want to see, right? So let's look at it, right? So you can see that the market has been in a range for a long period of time, right? Very long range since 2016 May to 2018 before it breaks out, right? So if you look closer at the price action, okay, I'm just trying to look closer at the price action, see whether can glean anything from it. Okay, so this one is I don't know what happened, right? But definitely, I won't even recommend buying, right, when the market breaks and close, at such a high level, right? Because why? This is, to me, is like chasing the market, because you don't have a level that you can, set your stop loss, right? The nearest one is at this structure low, which is very far away. Instead, right, let the market pull back, let the volatility die out, right, before you establish a position, right? Usually when the breakout is real, it doesn't just make one move, it makes a multiple move, right? 2 or 3 moves before it's over. So there's always chance to catch a move later on, right? So as you can see, I would say, right, this one over here will be a much better time to enter. As you can see, right, there is a pullback over here, and if you go long on the break of this highs, at least at this low over here is a level that you can reference to set your stop loss, right? Can you see? Right, you see this one over here, right? Market pulls back and then it breaks out at this high, something like this, right? You can see at this point, right, if you go long here, right, at the break of this highs or at this close over here, at least this swing low, right, is a level that you can reference as your stop loss, right? To set your stop loss, right? So and in this case, yeah, that would have let you catch another leg of the up move, right, before it collapsed down lower. And at this point in time, right, to me, the market is pretty much in the middle of nowhere. So I wouldn't really suggest buying here at this point in time, because, from a risk to reward standpoint, doesn't really make sense, right? So if you want to buy, I would say a good level to look at is at $7, right? You look at $7, the market. Let's see for a tool for this, right? Horizontal line. Right, so bear in mind, this is not any buy or sell recommendation. I'm just sharing with you my thought process on it. All right, this is a previous resistance. Price breaks out. Previous resistance turns support. Test once, test twice. So if you're gonna go buy, right, you wait for price to come back towards around the $7 level. Maybe the market does a false breakdown, right? Get a bullish hammer, reversal candlestick pattern, something like that. That will be a opportunity for you to go long over here. Okay, an alternate scenario that could also happen, right, is for this market to do a pullback, like a flag pattern, right? Like for example, this one you saw over here, you have this a flag pattern that's formed. Possibly you can get that, right, over the next 4 or 5 days, a flag pattern, and if the market breaks above the high of the flag, you can go long again. At this point in time, you have another swing low to reference from to set your stop loss, right? So there's a couple of things that I would look at, right, if you want to trade this particular stock now. Okay, and yeah, and that's pretty much it, right? This is a couple of ways. Another third one, which is more of a counter trend trade, is for this market to see if you can retest this highs, right? This $20, and then you get rejected. So the market retest this highs and then close bearishly, right? That would be a counter trend trade, right? To take a shot. I'm sorry, you guys can't short the market, so so just ignore that. Ignore what I said for the last portion. Okay, so that's for now. Okay, so let's see what other questions I have. So a lot of you are asking for replay, right? I suggest, right, reach out to the management, right, the people at Investorgrams, right, to find out how you can get access the replay of this recording. Someone asked, do you have a step-by-step guide to create a stock journal? Let's see. I believe I wrote a post on it on my website. Again, you can just get it out for free. How to create a trading journal. There over here, right? How to create a trading journal and find your edge in the markets. All right, this post is more than enough to answer your question. So I think Arvin asked, right, the PSE does not have a stop loss order or a trading stop. Is there a workaround? So yeah, I think maybe that's the finance industry generally in Philippines. I think in Singapore, most brokers also don't have like a stop loss order function on their platform. So the only solution that I can think of is to monitor your stock prices, right? And at the end of the day, right, see if it hits your stop loss, right? And then, exit your trade, right? So basically, wait for the candle close, right, before you base any trading decision. If the end of day candle closes and hit your stop loss, right, you exit your trade the next morning, right? So I think that's one way to go about it. Okay, another one asking about MRC chart. All right, let's have a look. Okay, so I'm just looking at it in the big picture, right? I can see that generally, I mean, really long term, looking at the, a few years of data over here, you can see that over here, right, this declining stage, then you have this long term, what they call a base form over here, a potential accumulation stage. Okay, and your build up, right, this time round, it's actually formed at this area over here. I mean, ideally, you would like it to be formed near this highs, right? In fact, you actually have as well, right? You just zoom in a little. Okay, right, this to me would be a build up over here at this area of resistance. You can see, right, this the concept I talk about build up. You have this one over here, so this would have been a valid setup to go long, going long on the break and close of the highs. Stop loss, right, 1 ATR from this low to set your stop loss, right? And again, depending on how you want to trail your stop loss, you can use the 50 period moving average, right, to ride the trend and etc. for this market over here, right? But chances are, I think you might have gotten stopped out, right? Hit your trailing stop as the market pulls back at this portion over here. Okay, so this is my take on the MRC. Where to go long at this point in time, right? One simple rule I have is that if the market is it's not doing something that you understand, right, stay out of it. So at this point in time, the market is in the middle of nowhere, like a range in the middle of nowhere. There's no point for me, buying, right? Because if I want to buy, a logical level to set my stop loss, right, would be, somewhere below this lows, which is so far away. Why not let the market come to a more favorable price, like let's say coming, towards this area of support, right? This previous resistance turn support, I would say the 50-cent level is a much more favorable level to look for buying opportunities, right? So this is for MRC, okay, for those of you who asked it. Okay, another one asked for IRC, right? IRC kind of remind me of the internet relay chat when I was a student back then. Okay, IRC, let's have a look and see what's about. So one thing you can see that this is a stock that is pretty illiquid, right? If you notice the gaps that is formed in the price action of the candles, right, it's not as liquid to the earlier charts that I look at. So usually when I look at charts that are not as liquid, right, technical analysis don't work as well. So usually when you get such illiquid charts, I won't even apply technical analysis to it. Okay, so that's my take. So for me, I don't want to analyze this because to me, this is not a very liquid market. You look at the volume, it's pretty low as well. So no, that's not. I think there's no point looking at this. I mean, there are traders who might be able to analyze and do it, but for me, I know what I'm looking for, and that is not something that I want to trade. Okay, let me just look through the questions. What else? So I would say, please don't ask me questions on fundamentals because I'm not a trader that use fundamental to base my trading decision, right? And I'm the worst person that you can ask actually. So please, that's not within my expertise. So someone asking, is there a recommended percentage to set your sorry, is there a recommendation percentage to cut loss? Yeah, I mentioned earlier, I think 1-2% of your account size is good risk management to practice, right? If you're risking anywhere like 20-30% of your account on the trade, I would say that is way too aggressive because it's a matter of a few losing trades and your account is pretty much wiped out. Someone asked doing analysis on the Philippine stock markets, right? So okay, let's have a look at the Philippine stock markets. What's the symbol for the Philippine stock markets? I'm not sure. Can anyone tell me? Is it PSE? Oh yeah, the Philippine Stock Exchange. Stock PSE, or is it Philippine Stock Exchange Index? I'll have a look. All right. Okay. Okay, PSEI. All right. Thank you. All right. So okay, so I'm just going to share with you my own analysis, right? So for me, what I like to do is is again, right, use the 200 period moving average because it tells you, you know, on which side of the trend to be on. So I'm just going to pull out the moving average, right? For those of you who watch my weekly YouTube videos, you know, it's something that I talk about over and over again. So I'm just going to find the moving average tool, where moving average tool. Okay, I need to find out how do I get the indicator out? Okay, not this. Oops, sorry. Right click, then insert indicator. Okay, thank you for that. Okay. Okay, thank you so much. Right, who's the one who told me that? Right click, insert indicator. Right, that's Clifford, right? Thank you, Clifford. Okay, so I'm just going to insert a moving average. Obviously, you can see that this is a line over here. Okay, EMA. I typically use the 200 to define the long-term trend. Right, so just put it to 200. Let's put it black color, thicken it a bit so you all can see, right? Okay, simple. Zoom in a little. So, right, I'm not sure if you all have seen before, but I keep emphasizing many times, right, that earlier, right, I mentioned, right, 200 MA can be used as a filter. If the price is above the 200 MA, right, chances are it's still in an advancing stage and you want to be long, right? You can have a long buyer still, you know, to buy your stocks. But the moment the index goes below the 200 period moving average, right, it's a bear market and, you know, you want to hold off any long positions. As you can see, okay, this is actually the, just going to drop some stuff over here. This color, let's change this color to red, right? This, I would say, is the potential distribution stage that actually occurred. Right, the market goes into range and finally break down below this area of a support. Okay, so at this point in time, right, the Philippine Stock Exchange Index, it doesn't look bullish. In fact, it's bearish. Price is below the 200 period moving average, right? And I won't, I mean, I'm just sharing my analysis, right? I won't recommend, you know, buying at this point in time because clearly the general index of the PSEI, right, is in a downtrend. Okay, so yeah, that's pretty much my take on it, right? Not bullish, price below the 200 MA, so be aware of it. So since you can't short or do anything, then there's really nothing much left to comment. Yeah. So Kevin asked, what's the difference between the SMA and the EMA? The difference is basically the way the moving average is calculated, right? Exponential moving average gives more weightage to the recent price point, where the simple moving average gives the recent price point or all the price point, right, equal weight to it. So James asked to elaborate a little bit about the ATR indicator. Again, I said, right, you can go down to my website. I have a blog post on it, right? Just read it, and I think you answer the questions on ATR indicator. Someone asked about house, all right? Okay, let's have a look at house. House. Okay, so my take on this house stock is okay. You can see that the price is above the 200 MA. It's bullish, but I don't have any trading setup to trade this, right? There is, you know, just no criteria for me to buy, right? So I'll just stay out, even though, right, price is above the 200 MA. That is one thing that is bullish, but in terms of you know, where to buy, right? I wouldn't say this is it's a good time to buy, right? There's just no setup for me to go along at this point in time. SCC, right? Let's have a look. So this is some Samirara Mining and Power Corporation, right? So this is a typical example of a declining stage, right? So the downtrend, price below the 200 MA, right? Stay out of it. You know, you don't want to be long at this point in time because the market is clearly, you know, not favorable for the bulls at this point in time. So stay out of it. SCC. Okay, so what else? Okay, so I'm just going to cover another 3 more questions right before we conclude today's session. I do apologize that I won't be able to answer all questions, but if any questions, right, you all can reach me, I think, either on Instagrams or through my email, my website, whichever you prefer. Okay, so let's answer another 3 more questions. A lot of chart analysis that's being requested actually. Okay, so this one is from Gerald, right? Is it better to add position in the bear market or just stay out and wait for the accumulation stage, right? I won't recommend adding in positions in a bear market because number one, you have no idea how long the bear market will last. And the more you add in during a bear market, the longer your capital can get trapped, right? Even for years. And what if the stock that you buy doesn't rebound, right? You can get stuck forever, right? There are stocks, right? They just, never come back. So again, right? Don't average into your losses. Okay. I mean, unless you know what you're doing, but generally, right? For those of you who are, you know, who do not have the necessary skill to average in your losses, don't do it because your capital can get stuck for a very, very long period of time. And there's no point compounding your losses over and over, right, into a stock that clearly isn't performing. So another one is Eldridge, right? Is it's from Adrian, right? Is bottom fishing an approach for fundamental analysis? Yes, I would say bottom fishing, right, is more for value investors, not traders, because value investors they analyze a security or stock based on certain value matrix, and if it's undervalued to them, right, they would buy irrespective of what the market is doing, whether it's in a downtrend or whatsoever. So I'll say it's more for value investing and not stock trading. And one last question is, let's see, what is it? Final question, let's do a stock market analysis, right? Just fire away. I'll see which is the most common symbol and we'll do the analysis for that stock, right? That's the final question that we have, right? So just any of you just want to have want me to analyze, I'll just take the majority, right? So let's see. Okay, the clear winner is Vita, right? There's like so many Vita down here, so let's just do Vita. Okay, Vita Rich Corporation, right? Let's have a look. So it always pays to look at the big picture to see where this stock is, right? So for Vita Rich Corporation, right, don't really know what it does, right? But clearly it's a strong stock, right? Its price is above the 200 period moving average, whereas the index you saw was actually below the 200 MA. So this is quite a strong stock. Okay, so you can see that generally long-term wise, right, you're looking at like the last 10-15 years of data, right? The trend is still intact towards the upside. So right now you can see, okay, a lot of huge movements in the recent weeks, months, right? Very strong breakout, then the market chopping up and down. So at this point in time, right, again, right, my take is very simple. If the price is in the middle of nowhere, you don't want to be trading it because there is no level or support, right, that you can reference to set your stop loss, right? So at this point in time, right, you would see where can you draw your support resistance, right? So for me personally, how I would draw my levels, right, so just let me look at this. It would be here. That'd be one level. Another level that's worth looking, I would say, is this one over here. And another level is possibly this one over here. Right, so right now, Vita, right, it's coming close towards this $2.75 level, right? Possible. Okay, one thing to bear in mind is that the PSEI, right, your index is actually in a bear market right now. So if you want to stay out, you don't want to buy, that's fair enough since the stock index is in a bear market. But for those of you who are confident of this stock, you're still bullish, right? I would say a possible level to look for buying opportunity is around the 270, 280 price area, right? You can look for a false break, right, where the market basically triggers below this low, right, does a false breakdown and then close bullishly higher. That would be a valid false break entry trigger to go long, right? And you can just set your stop loss again 1 ATR below the swing low if it does make a new swing low. Okay, and then if the market does reverse up higher, you can trail your stop loss, right, using the previous candle day low. So if the market goes up higher, right, you can trail your stop loss as long as it doesn't break and close below the previous day low, right? So that's something that you can look for at Vita, right? This is it's a level worth watching. I won't say buy immediately. He touched 270. Look for a shakeout where the market trades below the level and then reverse strongly back towards the upside. That to me is a shakeout, right? The higher the volume, the better. So that's something you can look for on a VTAR. Okay, so that's the last stock analysis and the last question that I'll answer, and that's all I have for you all in the today's 90-minute webinar session. I hope you got as much value out of it as much as I enjoyed presenting it to you. So thank you all, Investogrammers, for your time, right? And I appreciate it. Any feedback, questions, you can reach me on my website, and other means that email whatsoever. Okay, so thank you all. I wish you all good night, good luck, and good trading, and I'll talk to you soon. Oh yeah, so for the recordings, please refer to the management of Investograms, JC or John, the people who are managing the team at Investograms, right? They would be better equipped to point you in the right direction. Okay, so thank you all. Welcome Jay, welcome Kevin, good night John, good night Eric. You're welcome Clifford, right? Good night Frankie. You're welcome Chris. You're welcome Michael. You're welcome Lion. You're welcome, right? I'm glad you'll find value in it. Okay, so yeah, so just you can leave me any feedback on the Investograms, right? I would pay attention to the feedback as well. Okay, so with that said, right, I'm going to shut down the webinar, right, and have a fantastic evening ahead, my friends. Talk to you soon.